Okay, Bob, it's recording, so whenever you're ready, I'll take care of that.
All right, well, it still ain't here. There it goes. I see double zeros now. So I guess we'll get started. Good morning to all, and we thank all of our specialists and guests this morning for this edition of our Southeast Region grain and cotton marketing update. And just glad you're able to be with us this morning. Again, before we get started, I want to thank our sponsors, the Texas Corn Producers Board, Texas Sorghum Producers Board, and the Cotton Board, who help us in getting this out and we're just grateful for their presence in our program and efforts. So without further ado, I don't think there's anything else other than I know Matt Beauchet's been on here many times, and he's a co-host with us on this deal, and just want to introduce him. And he's the extension agent in Victoria County. So without further ado, Dr. Robinson, Dr. Welch, which one wants to go first this morning?
Well, we lead with cotton and then focus on grains for the last two.
Well, that works for me. If you're ready to go, we'll give you the floor.
Okay, let me get this thing in the right mode. Okay, well, here's a summary of the cotton market for the last 3 months. ICE futures this morning were trading at 118 something, so we're now at sort of a new high range, sideways range. We've been in previous high ranges. This all started back in September when we went on I forget, 10-day spree of just busted through $1 and kept on rising and kept on rising. A couple things I want to say about this. All of this is being fueled by speculative buying. I'm going to say the motives have changed. Back here, there were lots of questions about the size of the U.S. crop, and we were going to have a smaller crop, they thought, and all of that business. Well, harvest progress is well along that. I don't think there's really a question anymore about the size of the U.S. crop, and I don't think that's a object of speculation anymore. But there's still speculative money that's hanging on in this market. And I think it's in there for other reasons, and I'll get to that in a second. But anyway, we're at a historically high level. If you have cotton to sell, I don't know why you wouldn't have sold it now, and ought to be thinking about next year. And I'll wind up talking about next year. The supply and demand numbers that relate to the 21 crop are shown in this middle column, this third column here, and they didn't change much in November compared to the October publication by USDA. We're still in a fairly tight situation. Like I say, the uncertainty about the size of the U.S. crop here is becoming pretty firm guesstimate that we're going to have 18. We might have 18.5 million bales, but there's nothing really left in my mind to surprise the market. There may be some surprises. They may have to ratchet the export number. That's 15.5 million bales, and that may be too much. Not because we're not on track to sell that much, because we are. Sales demand, export sales demand is pretty good. China's in the market buying. They're replenishing the inventory in their national reserve, and that's kind of an artificial demand, but demand is demand. They're buying. But the trouble is we're having trouble shipping. We may not get to 15.5 million just because the merchants and the shippers can't get their hands on enough trucks and trailers and drivers and room at the port, room on a boat. That logistics question is a real problem, and that may limit this number here. But I think when it's all said and done, we're going to be, somewhere in the 3 to 4 million bales of ending stocks, which is similar to the previous year. And if you ask me what kind of prices would this justify, this outcome right here, I'd say, we probably have prices in the 80-cent range, maybe 90 cents at best. Well, obviously prices are a lot higher than that, and I think that's because we have a lot of extra jet fuel, a lot of extra speculative money that's kind of bid it up. I'll get to next year's numbers at the end of the presentation. But the point I keep driving towards is there's a lot of speculative influence in the market. And like I said before, back here, this green area shows the amount of speculative buying of cotton futures, and there was a lot of it this year, and it's been building. That's why prices were going up. Again, I think the reason they were buying back here was because they were making a bet that we would have a short crop, just a short supply and excess demand and that sort of thing. Recovering demand with a not a big enough crop means higher prices, and I think they were betting on that. Well, I think that bet is pretty much over. They're still long. You can see this green peak up here. These speculators are still really long the market. What I think they're doing now is what I'm calling a squeeze scenario. These speculators know that there's a bunch of commercial hedgers out there, that would be textile mills, who need to buy their way out. Those textile mills have a bunch of transactions, a historically high level of basis contracts. They've entered into basis contracts. They haven't finalized them yet. So they fixed their basis, what some merchant is going to deliver cotton to them and what they're going to pay in relation to the futures, but they need to actually fix the price. And in order to do that, they need to go in and buy futures contracts. And everybody knows that there's a historically high level of basis contracts that need to be fixed by buying futures. And these speculators know that these mills are in this position. They got to buy their way out of the market. And so they're in the market, they're long, they're still long, they're going to stay long, and they're not going to give these mills an opportunity to have much opportunity to get out of their positions, except at very, very, very high prices. That's what a trader would call a squeeze scenario, and I think that's what's unfolding. And so we may have some more upward fireworks, some upward volatility in prices as these contracts mature. So the December is pretty much winding down. We've got the March contract, the May and the July. I would go out and predict that because of this phenomenon here, I expect there'll probably be some more price volatility on the March contract, probably in about February, and in April for the May contract, and in June for the July contract. There's some upward fireworks that'll still happen as these transactions get finalized by the mills. And if these speculators are still long, just holding on to their long positions and rolling them forward, then it's going to kind of create that situation. So there's room for high prices. It'll be volatile. It's not really based on fundamentals so much. It's just kind of futures market dynamics. All right, I'll wrap up just talking about next season. I think we're still going to be in a world, recovering from the pandemic. I don't know if China's going to be buying as much as they have been this year. That's been a big influence this year, but I'm expecting somewhat similar demand influences. It's a La Nina winter forecasted. We're in a La Nina advisory. That means the weather is going to be drier and warmer than normal. So if we get similar acreage, which I'm also expecting, and drier weather, then I think we'll probably have average to slightly below average yields. And I think we'll have above average abandonment, and things will be a little bit tighter on the supply side, and they'll probably keep prices somewhat supported. This is just a little historical graph that would suggest that we ought to have between 11 and 12 million acres of cotton planted, given the ratio of corn and cotton prices. It would currently put us right in here somewhere. So according to the economics, we probably ought to have 12 million planted. According to droughts, the response of farmers to droughts, especially dryland farmers in Texas, and given a high insurance price, which I think we're going to wind up having. Right now, the insurance price is established off the December 22 contract, and that contract is trading in the low 90s. So shoot, if it's dry and we have a high insurance price, we could have 1 million more acres over and above what this would predict. But it'll be a weather market. It'll be uncertain, high abandonment, uncertain harvest. So we'll have to see how it plays out. Here's are just some numbers I would expect. Average yields, above average abandonment. I figure we'll have tight ending stocks again, between 3 and 4 million bales. And I think we're going to have the market return once the market gets out of this squeeze dynamic that I was talking about earlier. I don't think we're going to have dollar cotton anymore, but we'll probably have prices trading up in the 90s, in the 80s and 90s. maybe at the harvest time lows next year, next fall might be, 85 cents or something like that. That wouldn't surprise me at all. And that'll wrap up what I've got. I've got my contact information here, and I welcome any questions anybody might have now, or if they want to email me later. I would appreciate that. Bobby, I hand it back to you.
Thank you. I kind of got a question. I mean, looking from producer perspective, in those March futures, would you think that there might be a reason to maybe contract 10% of your crop or something at that time, or is that still a little presumptive?
You're thinking about the 22 crop?
Yes.
As prices as high as they are, if the last time I looked, December 22 was, 92, 93 cents. It's hard to make a recommendation for somebody to go contract when we're in a dry La Nina winter. But if somebody's got irrigation and, if they can, I would say consider contracting, some portion of your reliable production. I wouldn't be averse to contracting 10, maybe 20% of it. It depends on your production risk, but you could tailor that to your insurance, your expected insurance contract. If you have an insurance guarantee of 65%, if you could have a yield policy that would give you a yield guarantee. Well, you could contract some portion of that because you've got the protection of the guarantee.
Yeah, just looking at a producer's perspective,
Well, I think Dr. Welch is going to make this point, and it's worth making in cotton too. The way it is with high input costs is you have to lock in, when you buy that fertilizer, you have locked in that high input cost. Same for your herbicide, same for your machinery. So you're locking in all the historically high costs. And we've got high prices, but if you go on later in the year and you don't fix your output price and the price drops, then you're in a world of hurt. So if you're going to lock in if you're going to choose to produce something and plant something, and you're going to lock in high input costs, you better be thinking about locking in high cotton and grain prices too.
very good. Any other questions?
Good info.
If not, again, thank you, Dr. Robinson. Very good information, and I'm glad you're with us this morning. With that, I'll turn it over to Dr. Welch, let him talk about the grains.
All right. Appreciate that, Bobby. Matt, thanks for having us again. See if we can get the things set up, and hopefully you can see that schematic representation of the U.S. grain market. Obviously, there's lots of factors that go into shaping what's going to eventually be the grain price. We're going to focus on one particular element of that here this morning, and that is these much higher input costs that we're going to be looking at for 2022. Whether you're putting a wheat crop in right now, or of course the spring crops we'll be planting in a few months. And I want to look at this from two perspectives. One is the challenge that an individual producer will face on what are you going to do? What are you going to plant? What will be the management decisions you will make around these much higher input costs? And then I want to look at the implication that these higher input costs have on shaping the national grain price. So in other words, how might this play in, particularly into the corn, soybean planting decision up in the Midwest that really drives where our grain prices are going. So we'll kind of touch on a couple of elements of what these higher fertilizer prices are doing to us. Those are monthly prices for anhydrous ammonia, which of course that relates to many of our nitrogen products, the price of natural gas, which is the primary input component to produce ammonia, and then what corn prices have done over the last year. And again, these are national monthly prices, and corn is still relatively high, around $5.50 a bushel, down from almost $6.50 back in August. But we're seeing natural gas, some of the highest prices in the last 10 years or so. That ammonia or nitrogen price, those are all-time record highs. We're pushing those to levels we have not seen before. Put that in a little broader perspective. Let's go back to now look at seasonal or annual prices going back to 1997. Again, our anhydrous ammonia is priced in blue. Again, those are record highs. And when I say a seasonal price, that's the average price per ton starting in September into the next spring. So we've got a lot of winter ahead of us. Doesn't mean we're going to stop at $950 a ton by any means. That could still go well higher. Again, you can see the price of corn there in green, and natural gas prices. Again, that's kind of a seasonal or annual average. We've been much higher back 2005, 2006, but certainly are seeing a surge, which puts upward pressure on the cost to produce nitrogen fertilizer, but nowhere near record highs that we saw back in the early 2000s. But this is another way to price anhydrous. How many bushels of grain does it take to buy a ton of ammonia? And so in this case, you divide the price of anhydrous ammonia by the bushel price of grain. And if you look at these higher prices for corn, and I've got wheat charted here too, we're not looking at record prices in terms of bushels per ton. Yeah, that 179, 180 bushels to buy a ton of fertilizer, that's high. That's in the higher range that we've seen since 1997. But certainly it's not above that 200 bushel price that we have hit several times. If you look at wheat, 122, kind of where we're sitting right now, again, with very good wheat prices. That's really kind of more along the mid-range when it comes to wheat relative to what that price in bushels has been since 1997. So again, I think it's very important to remember and to put into context, what is the value that's created with these higher input costs? And
so before we talk about this, there's a report that came out. It was independent.
Nope. If you've got a question or comment that'll come up there, I heard something in the background, please, we'll jump on that here in just a few minutes. Be glad to entertain those. So again, just try to put in context. That doesn't mean you're not going to have the challenge of an extremely higher financing when you're putting in this 22 crop and a lot more financial risk. But in terms of the perspective of the value that is creating in these current markets, I think that helps put it in context just a little bit. And as Dr. Robinson mentioned, and I want to highlight when it comes to grain markets, the concern is that we lock in these higher input costs in the winter and the spring, and then only to see our grain prices, particularly by fall dramatically. We saw that in 2013. We were pushing at that time to the highest fertilizer prices we had seen, and saw a big drop off in grain prices by the time we got to fall. Same thing happened in 2008. Big surge in fertilizer prices at a time that we saw grain prices moving lower. Even though it was early 2000s, we were seeing grain prices drifting lower at a time that we were getting upward pressure on fertilizer prices. And so that they don't match up at the time that we're laying out our input costs and the time that we're going to be locking in the price for our production. And so I think the incentive or the management marketing skill will be to lock in or put a price floor around. If we've got those higher input price locked in, those are set, can't change them. If it is that higher grain price that makes that higher input cost work, then we certainly need to be implementing the tools that protect that higher price. Where do I think we're going for grain prices for 2022? If you look at U.S. corn use over the last 5 or 6 years, it's been pretty flat. Domestic use particularly hasn't changed much since 2016. If there's any variation in that total use number, it's come from the export market. And I think that will be the case as we move into 2022. We could see perhaps fuel use go up a little bit if the economy continues to improve, and ethanol is a pretty good buy at these higher higher gasoline prices. But I think we are seeing a tightening in some of our livestock numbers. And so with these high feed costs, certainly the incentives are for our livestock producers to put on all the pounds they can outside the feedlot before they put those animals on full feed. So I think there'll be some downward pressure on feed use. And I do expect in 2022 to see that increased export competition from around the world. Currently, USDA is projecting a record high corn production from all of our major corn export competitors: Brazil, Argentina, Ukraine, Russia, all of them for the 2021-22 crop are expected to have a record high level of corn production. And at these prices, the incentives are only there for them to continue to push their production as much as they can. I had to plug a corn yield for next year. We've been right at trend line here for this 21 crop, amazingly, given how hot and dry it was in much of the Northwestern Corn Belt the whole season. But it looks like that the current estimate from USDA, 177 bushels, is right at the trend line estimate. If you draw that line going back to 1950, and that would be an all-time record high in a year that we had less than ideal conditions for a good chunk of the Corn Belt. You draw that line out one more year for 2022, that would plug us a yield at just over 178 bushels per acre. So what about acres? What are farmers going to do? And so if you look up in the Midwest, which will drive our corn outlook in terms of their economic decisions, and we're talking about up there corn and soybeans. These are updated budgets from the University of Illinois. They updated these in October, and their budgets, even with these higher fertilizer prices, and they have higher prices as well for their pesticides and for seed. Get down to that bottom line, corn is still more profitable for average budgets across the state of Illinois, even with those much higher fertilizer requirements, particularly nitrogen, of corn relative to soybeans. We're looking at, again, total cost, you're spending almost $300 an acre more to put that corn crop in. But even with that, with these prices where they are right now and the productivity of corn, the corn relative to soybeans is still favors corn at this point. And so their bottom line note was that still budgets suggest large swings in acres are not likely at current price levels. So again, even with record high nitrogen fertilizer prices, their analysis would indicate that the budgets really haven't changed that much. And so they don't expect that to have a huge influence on acres. And so what do we think for next year? Well, we planted 93 million acres in 2021. If we hold that steady and say we plant 93 million this year, or for 2022, excuse me, and have that yield around 178 bushels per acre, we're going to add to corn stalks. That's going to be above what I would estimate to be our total use of about 14.8 billion bushels. That's domestic and exports. Again, I don't see a lot of growth in that market at this point, given normal conditions around the world. And so really at a trend line yield, if we plant anything above 90 million acres, we're going to add to corn stalks. And of course, we're adding to stocks, we're putting downward pressure on prices. USDA has released their long-term projections, and it kind of fits in with the scenario I'm trying to paint. They actually lowered planted acres by 1 million. They're plugging in 92 million, but their yield's higher too. They're plugging in 181 bushels per acre as a starting point. Their total use number, right where we are right now. Again, not expecting any growth on the use side of the ledger, and that would then push the stocks to use ratio up to 13%, up from 10%. Days of use on hand to almost a 48-day supply from the 37 where we are right now. Season average farm price from $5.45 a bushel down to $4.80 a bushel. So what that looks like, that's got us moving down this days of use on hand, dropping below that critical 40-day threshold that we've talked a lot about, dropping that back down to about a 46, 47-day supply, and again, putting some of that downward pressure on prices, which is particularly significant given the higher input costs that we're going to be locking in this winter. So the challenge, I think, management-wise, is to be as efficient as possible with every penny we spend on the input side. I do expect that we will see U.S. corn stocks increase in the face of increasing global competition and steady domestic use, pushing prices moderately lower. And again, how much lower can you stand given these higher input costs? I think that's the management question that we're going to be dealing with this winter. And again, that depends much on the recovery in the global economy. Are we going to pull out of the COVID recession? And again, trade is absolutely critical. And access to trade, the fewest disruptions and disputes related to that. We've got a long way to go in the supply chain for a lot of products, and grains and fertilizers and other inputs flowing in, as well as our commodities flowing out, all pulls into that. but weather will be the dominant force, of course. But those are the factors I think we need to really be paying attention to. And if we can help with some of those management tools or resources around managing those prices, gosh, that's what we'd love to do. We'll be having our master marketer program in January. A good portion of that content is going to be online if you can't join us in person. And so we certainly invite your comments, your questions, and let us know what we can do. Appreciate it.
Again, great information, Dr. Welch, and we appreciate you getting up early again and being with us this morning.
Yeah.
So with that, we'll move to our guest, Bryce White, who is the Producer Relations Director for the Texas Corn Producers Board. And again, we thank you for being with us and for y'all's support in our efforts. And with that, I'll turn it over to you. And unless there's any other questions for Dr. Welch, and turn it over to Bryce.
All right, sounds good. Thank you. So I just have kind of a brief update about what we've been doing. I think the last time that we had a chance to speak to y'all was in August. And so since then, we've had a lot of stuff, it feels like, that we've been doing from the Checkoff and Association. One of those, Dr. Welch was talking about fertilizer. We've been talking to a lot of our counterparts on Capitol Hill and at National Corn, and trying to figure out what role could be played by the government in fixing some of these issues. There's not an answer right now, but we've definitely been keeping that conversation going on a weekly basis with them, trying to see how we can help get some support for farmers. Our main concern has been that we know that with the steel and aluminum tariffs and now inflation and what we're seeing with fertilizers, that the input costs continue to rise for farmers, and we're definitely not a fan of just continuing to stack that on their back. And so our directors have been pushing us to see what we can do to find avenues. And so we're hoping that in the next couple of months we can report back that we've hopefully found a solution to help with that. But right now it seems that the International Trade Court, a lot of that's in their hands, and it's definitely not something that you can fix politically. So we're trying to see what other answers there are. Another thing, we did go to DC back in September with some of our growers because the time of year we did get to have a lot of our South Texas growers, Gina Shugaric and Colin Chopless and Charles Ring from y'all's area. They joined us up in DC, and we really hounded a lot of our concerns with taxes and what I'm sure y'all have all heard by now from what we were hearing might be included in some of these huge legislative packages that are being passed right now. And so we really fought back on the stepped up basis thing, and we ended up hearing from a few offices on both sides of the aisle that all the different farm organizations that went up there and really pressed that issue and told them what it would do to destroy family farms, that it really helped turn the tide on that issue. And so that's something that we really think growers should be commended for taking the time to go up there and do that, because they probably saved generations worth of farms by doing that. On the checkoff side, we do have some, I believe about a year ago, we were down in Robstown and had Tiffany Lashmitt do the Successful Succession workshop where it was about doing estate planning. Now that those in-person series are over, that is actually up on our website. Some video recordings and all the materials are now available. And so if anyone's interested, you can go to texascorn.org and it'll be up on our website for you to find. One of the last things that we've got going on in y'all's area before the end of the year, I think that in the 2018 Farm Bill, they passed a feral hog eradication program, and they started part one in Texas, and it only had a couple counties in Texas, and really limited our state for getting federal aid for feral hog eradication. And we were able to work with some folks at USDA to add counties, and so we're happy that USDA added Sampat, Nueces, and Bee County. And so we're going to be hosting a dinner on December 8th at 6 o'clock at the Butter Churn in Sinton. We're planning to have some of the wildlife biologists come and speak to farmers and get some permission to be on land to do some of the eradication programs, but also help let the farmers know what resources are available for them to use to help with that. And so with that, that's pretty much the highlights of what we've been doing the past few months. We look forward to seeing a lot of y'all in a couple of weeks. If you're able to come meet us for dinner, dinner's on us. So a free meal always helps. But Bobby, I think that's all I got.
Great. Again, thank you. And I just wanted to plug your successful succession resources. I looked at them the other day, and they're easy to get to, easy to read, a lot of good stuff there. So if you're in that mode at this point in juncture in your life, well, there's some good resources there to at least get you started in the right direction. Appreciate y'all doing that, and I think it'll be a great resource for a lot of agricultural families. So again, thank y'all for all that you do. Any other questions, comments? Matt?
No, sir. Thank you, everybody. Appreciate you this morning.
Yeah, it's always good information, and we appreciate y'all getting up with us. And with that, I hope all have a time to be with their families and enjoy the Thanksgiving next week. So with that, I guess we're done.
All right. We'll see you guys.
Good
Appreciate
morning,
it.
everybody.